What's up, guys? Welcome back to DCA. Today what we're going to do is talk about the DCA Index model. The DCA Index model was coded in MATLAB using econometric and machine learning toolboxes in order to attempt to predict when we may be approaching a market cycle peak or a bottom. So essentially, this model takes into account diminishing volatility over time, as well as decreasing extension from key market levels over time. And that's the key element that goes into a model like this. Now, if you've ever seen Into the Cryptoverse by Dr. Benjamin Cohen, you may have noticed a similar model called the risk metric. So this model attempts to answer many of the same questions that the risk metric attempts to answer, and in fact arrives at many of the same conclusions. The issue being, in order to gain access to the risk metric, there's nearly a $95 a month fee. So, if you're a college student or a young investor or you're new to investing, you may not have that type of money. And in fact, the opportunity cost of investing $1,200 a year into a model that you could have otherwise been investing into crypto could be massive. So I wanted to attempt to create a model that would be free, that anyone would have access to, and wouldn't be restricted to only wealthy investors. That's how I decided to come up with the DCA index model. Okay, guys, so on the bottom is the risk metric and on the top is the DCA index. You can see that these two models very similarly answer the same question, and that is, when are we at a market cycle top and when are we at a market cycle bottom? As we're getting into the yellow and then farther into the red, we're reaching a top, and that's when it's becoming less advantageous to hold your Bitcoin. You should be selling it at these times into the retail market that is buying at these inopportune times, versus when it's coming down into the dark blue areas, that's when you should be acquiring, that's when you should be buying Bitcoin. So these two models are essentially answering that same question in a very similar manner. Okay, guys, so just to quickly go over exactly what this model is, or how it works anyway. This is the price of Bitcoin, and then that would be on the primary y-axis. And on the secondary y-axis, you have a color-coded region. This region is then transposed onto the Bitcoin price. As the color becomes deeper blue, it indicates that there is a higher chance that you are nearing the market cycle bottom. And once it's in the deepest blue regions, approaching zero, that's indicating to you that these are historically the best times to be buying Bitcoin. When it's yellow and then approaching red, these are the best times to be selling Bitcoin. So a model like this helps us to develop a strategy where we can be buying at times when other people are selling and selling at times when other people are buying. Essentially, you can think of this as a smart money index. The smart money is acquiring Bitcoin down here. The dumb retail money is acquiring Bitcoin up here, okay? So basically, you can think of this as modeling investor psychology. The retail investors are buying in these regions, and that's where you will be selling to them when you're using a model like this. Then the retail investors will be selling Bitcoin in these levels, and that is where you will be buying it from them so that you can maximize your profit. So this is the DCA index coded into TradingView. You can see that as opposed to being color coded, now the Bitcoin graph is on this upper XY axis and the DCA index is on this bottom XY axis. So as we said before, when the market is at the best times to buy historically, you're approaching these deeper green areas. When the market is at the best times to sell historically, you're in these 80 up to 100 levels. We can use this information to attempt to develop a strategy for purchasing and selling Bitcoin. So one particular strategy you could use would be a more passive strategy. Now, this would be the most basic way you could use a model like this. So for instance, if you were going to say dollar cost average $100 per week, you would just simply, no matter what range you were in, below 50, dollar cost average $100 every week, no matter where you're at, as long as you're below 50. And then if you go above 50 into the 50 to 60 level, 60 to 70, etc., you would simply sell 20%, no matter where you were, as long as you were above the 50 level. But you would really be limiting your profits by, using a strategy like this, because you wouldn't be leveraging the opportunity presented by these lower DCA tiers. When they're in these lower levels, historically, these are the best times to buy. So you should be taking advantage of those times and buying more during that time. Likewise, when you're in these 50 to 60, 60 to 70, etc., when you're in those ranges, you would not be taking advantage of knowing where you're at by selling just a blind 20% of your holdings every time. A more aggressive strategy would be something like this, where you say that when it goes from 50 to 40, for instance, down to 40 to 30, you will increase the amount that you're going to invest. So you would say go from 50 up to 100. Okay, so you would call your X 50. X is what you're going to make your baseline investment level. So this could be 50, it's whatever you decide your baseline investment level will be. So then you would increase that incrementally into each new DCA index tier. So these numbers can get quite high, especially, if you get down into a range like we did in late 2018, where if we bring this down, we can go look at where we were at then. So we were down in this lower pocket here for quite a while, which would have had you in the lowest 0 to 10 level. You would have been investing $250 every week or whatever month, whatever time frame you're using, and we were down in this level for quite some time. So from 1125 all the way up to 329. If you would have been using a model like this, you would have known that historically this is one of the best times there has ever been to be acquiring Bitcoin, and you could have been doing so for just a few, about $3,000 for almost 4 months. So, that opportunity presented itself, and this is the time where it's difficult. It's difficult to buy because there's nothing but FUD. There's nothing but doom and gloom. Every single person out there is saying Bitcoin's done. But if you have conviction and if you believe in Bitcoin, you believe in what Bitcoin stands for and what it can be, this would have been your time to essentially acquire life-changing wealth. Okay? So having a model like this would have told you that, these are the times to be buying. When the COVID capitulation event happened, this is the time to be buying. This is the time to acquire as much as you possibly can. And with these levels, guys, you don't have to be strict. If I can't stick to exactly my 5X because I just don't have the money this month, that's fine. You just do what you can and you try to acquire more as it heads down into deeper DCA tiers. So conversely, when you want to sell, guys, what you'll do is you'll take these values and you'll say, how much do I want to sell at each level? And if you're being slightly more aggressive, you'll say you want to sell more in the higher tiers because historically, these are the best times to be selling because you're getting the most value at these times. So you would look at each level and you would say, okay, when we're in the 50 to 60 range, I feel confident it's going to keep going higher. So I'm only going to sell X amount at that level, or Y amount as I have it here. And then in the highest tier, if we get up there, that's where I want to be selling most of my Bitcoin. So I'm going to sell 5 times as much there as I did here. So 5Y. And then so on and so forth. And you can assign whatever value you want, but you want to be doing it incrementally higher, right? So to come up with the numbers then, you'll add these up. So 5 plus 4 plus 3 plus 2 plus 1, and that's going to give you 15Y. And then you'll divide that by 100%. So each Y is worth, in my example, your case can be different. In my example, it's 6.67%. So then it's Y equals 6.67, 2Y equals about 13%, 3Y equals 20%, and that's just, multiplying 3 times this Y value, 4 times this Y value, so about 27%. And then finally, up in the highest level, you would sell 33% of all of the Bitcoin you started with down here. And that's how you do it, guys. So then you've sold your Bitcoin, and then once it starts coming back down, so you sold up here, then once it starts coming down back into these ranges, you just start acquiring it again. You start buying it from the dumb money who's willing to sell it to you down here because they're scared. They get scared. They're worried it's not going to go up. That's how at 28,000, you should have been acquiring a ton, and it was like right there for the taking, 29,000 range. And sure enough, here we are, we're headed back up, and we're in this range now. We're in this 50 to 60 range. In fact, so what this model is going to do, if we just come out here, you can see we're at 58.88 right now with a Bitcoin price of 64,200. So we're only at a 58.8 or 58.9. And this model will update daily right on TradingView. Okay, so it will tell us exactly where we're at and exactly how risky the market is at any given time. So for reference, if you were wondering, the last time we were around this range was in November of 2020. And at that time, we were, sitting at around 18,000. So we went up 3x from this level. But you wouldn't have been selling a ton of your Bitcoin here. You would have been waiting. You would have been waiting and then selling as you went up. Okay? So that's how a model like this works, guys. And, you can see it would have had you acquiring lots of Bitcoin basically all through 2019 or 2018, 2019, 2020. You're acquiring, and then unloading in 2021 for massive profit. Okay, so that's how something like this works, guys. It's these strategies that I laid out here. These are just examples you can do. There's lots of different things you can do. I just put one more here where you would do sort of a combination of strategies. So maybe you do X all through the 50 down to 20 range. And then when you get down into the 20 to 10 and 10 to 0, then you really step it up. And vice versa, maybe 50 to 60, you don't do anything. You just sit because you're going to just sit in this range. You're willing to be more aggressive. And then you start really selling as you get into these higher ranges. So there's a lot you can do with it, guys. There's a lot of different strategies, but the key thing is this helps you identify where you're at, and it helps you figure out when you should be unloading and when you should be buying. It helps you become the smart money, and it helps you sell to the dumb money and buy from the dumb money at the appropriate times. So I think that's it for this one, guys. I hope you like this. I hope you like this type of information. I'm going to be putting this on my videos every day. I'm still trying to get it into a form where I can send it out to everyone. So there will be more information on that coming up soon. But if you like this type of content, hit like, and hopefully you guys could subscribe. I'm a new channel, so it goes a long way to help me. Hit the notification bell for time-sensitive updates. And until next time, see ya.